Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, January 14th, 2022. It is 1:49 Eastern Time as I'm starting the video, so we have a little more than 2 hours to go in the trading day. Just a quick update or correction. Somebody on the site had mentioned, thank you very much. I forgot it's a 3-day weekend. We have markets closed on Monday for, I believe it's Martin Luther King holiday. Their question was, does that change my thoughts? No, absolutely not on what I said earlier today. Look, again, anything's going to happen on Monday. We're either going to gap up, gap down, or open roughly where we close. That's it. For the reasons I stated, it wouldn't matter whether today was a Wednesday with a trading session tomorrow, a 2-day weekend, or a 3-day weekend. You know, we park today. The markets are going to close, stop trading at 4 p.m., and that's what the charts are going to look like. And as of now, we're about where we were this morning when I started the video. So really, again, nothing's changed. Only other thing is we're getting really close. I'm going to jump back to this, and then I'll tell you what I'm going to cover. But we're getting really close there on IWM. You know, that's down over 1% today to breaking down. So again, look, I always say this, you know, if you're bullish and you think this market's got more life left in it, at least in the near term, you can see this. I'm drawing out what would be nice positive or bullish divergences. If all we have to do, we already have the divergence in place, or almost. So technically speaking, we just have to equal this low right here or exceed it by a slight margin, not too much to take out the divergences, and then you'll have negative divergence. So there is a possible setup. And I'll tell you, that gives me a little pause, absolutely, on my RTY IWM shorts. But you know what's going to happen? We're not going to, again, technically have divergence until we go down and equal or exceed that low. So on Monday, or I'm sorry, on Tuesday, when things pick up, and we'll know, you know, going into the day, I'll see what the futures. If they're doing anything big, I'll do an update and let you know. I'll look at the 60-minute charts, look at the futures, look at QQQ and SPY, and see if anything's changed. One thing you can see, well, maybe you can't see it. I'll let you see it here on this IWM chart. That's the 200-day simple moving average in blue. Here's the 200-day exponential in red, and there's the 50-day moving average in yellow right there. And you can see they're all, I think you can see this, they're all, we're below all of them right now. We've had a couple visits, but look what's happened. You look at them, they're clustered up here. Here's again, the blue line, that's the 200 simple, 200 exponential, and the 50-day. Those are key moving averages. And you can see for the most part, we broke them all there. We took out the 50, went on to take out the 200 simple and the 200 exponential. We back tested the 200 simple. So the simple, and I use them both because some traders use one, some use the other. And so I want to know what everyone's watching. And I can see IWM is acting a little bit better off the 200-day simple, the blue line. But you can see a solid impulsive breakdown, back test 1, back test 2, and a rejection. And now it is trading below all those key moving averages. It has been for a while. So, and that hasn't really happened other than since we broke down here. That hasn't happened at all since since we recovered them all right after the Fed came in and gunned the markets after when COVID first hit. And then we broke above them there, back tested all three. So there's something there. And again, those are the things that I factor in to decide whether I want to go long, a breakdown with a divergent low, or hold tight and wait for and see if those divergences get burned through, because that's pretty significant stuff. A lot of traders put a pretty good emphasis on the moving averages. Okay, what we're going to cover now, I'm going to go through, I've already done the indexes today, so there's no reason to cover them if we're still trading where we were. I'm going to go through, give you an update on IYR. Again, I covered it this morning once, but I definitely want to update it since what's happened since then. Financials, XLF. I was supposed to cover that in the last video and I forgot to do so. I want to give you, there's an actionable or some things to note on natural gas. I've been on that lately. The euro, which I just got an update out to you with a screenshot, and I'll just kind of update that, my thoughts on the euro and gold and silver as well. So that's what we'll keep it limited to, those handful of things. And let me cue up the IYR chart here. Okay, so in the update, or if you're just catching up, I put IYR and it's a short here recently. We went down, and I showed you the levels that would that would be, I called that an aggressive short entry because it was in anticipation of a breakdown that had yet to occur. And here's a great example. We all see things as we want to see it. If you're bullish, you're seeing things glass half full, and then you buy pullbacks to support. And that works until it doesn't work. And when the technicals are pretty clear, then I look, instead of positioning long to go long on a pullback to a support, I then wait for a break of support. I'm expecting or looking for that to then make a case to be short. Now, this one, my confidence was high enough based on everything that's going on to add the entry right there, or here. It was one of those two a week or so ago. And then most recently, I pointed out to you guys a bear flag continuation pattern right there. Bearish pennant, really. There's your flagpole. This is the measured target. It would take us down to my first target there. The measured target's a little below, but when I take a measured target of a technical pattern, a chart pattern, and it comes, if it comes close to or just overshoots the support level, price support, that's where I want to cover. I'm not going to try to eke out an extra 0.5% or 1%. Again, that's just where I expect an initial reaction. I may continue to sit tight on it. We'll see what the market's doing when it gets there. I gave you additional targets all the way down here. It's my current final target. So again, I just wanted to do the update because this is exactly what I wanted to see. Again, doesn't guarantee anything, but it increases the odds, and that's what I always talk about. Trading is simply about putting odds in your favor. It's just, I'm not a gambler. I don't go to Vegas, but if you do, you play the games, or you wait, play the hands that put the odds in your favor. Poker players do that, and everything else. And that's what we do here. That's all you can do because there are no guarantees. But when you see a breakdown, you can look up bear flag or bearish pennant, bear flag continuation pattern. That's the textbook sell signal right there. An impulsive break, that's a big red candle, and in one fell swoop it took out both the flag, when you zoom in real tight there, and it's now taken out the trend line. So with 2 hours to go, this thing would have to giddy up real quick and rally up to get back above that level to regain or close on the trend line. Otherwise, and that was what we call a stick save. If they can do that, great. I don't think it's going to happen. I already did a whole video showing you the top components. It wasn't just this ETF, sector ETF, that was bear flagging. A lot of the top components were also bear flagging, and I'm sure if I took the time to go through them now, we would see that most of those are probably also broken down. So that's it. Final note on that, like any sector in the S&P 500, because REITs do comprise it's one of the 11 sectors in the S&P 500, it's certainly going to help the case that we're going to go on to hit even my minimum target, but any or all my targets, to see the broad market breakdown. Remember, the broad market's still right around has some key support levels below, so factor that into your trading, factor that into which target or targets you're going to go for, because if we start to see the floodgates open on the market, like I think may happen soon, then you might want to just sit tight and ride out any counter trend bounces and go out, instead of trying to hit a single or double, go for a triple or a home run. Next up, financials. We had some big financials reporting this week, and so that gets that out of the way. If you recall, I put a call out earlier in the year. I know making market top and bottom calls is a fool's errand, in sectors, but that's what I do. Call me a fool. It's what my trading, to a very large extent, entails trying to catch tops and bottoms, inflection points, reversals, breakouts. Sometimes they're continuations, and not always calling the turns, but or buying pullbacks to support. But in this case, I guess it was back here, probably on this first one. Yeah, that was it, because I laid out targets for you, and I figured that to be a top. And I talked about this when we got here recently, that my definition in trading and investing, there's a difference between being early and wrong. And now the difference of being wrong is if you say you took that trade and you're going for this third target, 31.35, and so, or more, because I think there's going to be more if it's a major top. That's just the 3 initial targets, but in that case, you're talking about a 20% drop to just that third swing target there. Then you can allow yourself a 7-8% stop loss order. And so sometimes trades you break down. In this case, we already hit the first target, but we did so with divergence. Sometimes you just keep going, and then sometimes you put in a marginal new high. Either way, as of today, from where we topped back in May, again, say what you want about it, whether it's top, wrong, early. We went up about a total of 7%, but we're at this point in time right now. Today's candle is right here. We're only up. Measured it earlier. Here it is, less than 5% from where we were again back then. So it's a lot like many sectors out there, and like IWM, things that have topped and been moving around for a while now. It is coming off a new high. So you certainly can't write it off, and only time will tell if I'm wrong. But when I look at this, here, let me jump over to the weekly chart. Okay, so back then, earlier in the year, we put in, just focus on this line here. Forget about this trend line for a second. Look at these two. This is what I highlighted. This is a very clear, clean uptrend line, comes off what I call the COVID lows back in March of 2020. Distinct reaction there, reactions. So that uptrend line, and this is our divergence line right here, that forms a very clean and clear and unmistakable bearish rising wedge pattern. One of my favorites. Love the wedges, whether they're bullish or bearish, and complete with negative divergence, everything you want to see. So that was a divergent high, like I said. And again, when you break a wedge, it is not uncommon. I don't know the odds really. It depends on the security itself, and I don't know if there's any statistics out there, but it's close to 50-50. Who knows, 60-40, doesn't matter, that you either break down and then kick back and back test the wedge, and then get the next leg down and then back testing, because the nature of a wedge or any uptrend lines are upward sloping. So therefore, if you back test an uptrend line, you're always going to come in at higher levels from where you break down, just by the nature of it, because they come in at higher and higher prices every day, right? And so that's what happens. And so when it did, we back tested. The divergence not only was not burned through, but it was extended. It got even larger. Remember, we had divergence here, but that divergence just grew on the back test. So far, rejection, but not a lot. Now, I tell you, the problem with back tests, number one, there's no guarantee that you are going to get rejected. So you can't go bet the farm there. And sometimes you back test for weeks, even if you are going to be rejected. So what you really want to see, and it's not going to happen this week, but you want to see a pretty impulsive rejection. You want to see some follow-through red candles. This week we're going to get a red candle, almost certainly. There's one in the making now with the market, poised to close soon. But that's what you want to see. So if next week is a ugly week in the markets, or even just in the financials alone, look for that. Look for really to see if this big green candle gets taken out. That would most likely be the nail in the coffin for the financials. But there it is. So my reply to the question in the comment section from earlier today is, someone asked for an update on the financials. Nothing has changed from my outlook. Nothing has changed technically. That's why. It's not that I'm just trying to stubbornly hold on to a call. I'm either going to be right or wrong, and I'm fine with them being wrong. I'll tell you, that's the only guarantee I'll ever give anybody about this site or my analysis, is I will guarantee you that I'm going to be wrong, and I'm going to be wrong a lot. That's the nature of this game. The key is to cut those losses or minimize the losses when you are wrong, and use favorable risk-reward ratios. Don't risk $1 to make $1. You want to risk $1 to make $2, $3, $4. And then the other point is, you're going to be, right plenty of times, and when you're right, those are some, especially when you're looking at, big calls like this, because if that is the case, from where we're at right now, we're going to see my first target on the weekly time frame is about 35.15. That's about better than a 13% drop, and then ultimately, this is where I think we're going down here before all said and done, 22% drop. And so again, that's be profitable. You could trade that any way you want. You can pick the individual components, the most bearish stocks in the financial sector, and short those, and ignore those with the more bullish charts or the better looking charts, or even go with a hedge portfolio. Buy some of the best looking ones and short the most bearish. But that's it. I don't want to spend too much time on it. Work to be done. One of the work would be to see this PPO signal line, the white line, cross down below the zero line. That denotes bearish primary trends. You can see from there to there. Caught most of that big drop. It caught the big drop down here. It doesn't get you in and out like an exact timing indicator because again we're looking at a weekly chart here. We hone down to the, to hone our entries, we go down to a daily chart, and you can see here. So here's what's happened on the daily chart. This is that same. Let me roll back. That same primer uptrend line that comes off the COVID lows right there. Breakdown, back test, just what we were looking at on the weekly. But again, this is why I start stepping down to the shorter time frames to give me a little more visibility or clarity on the timing of these trades. And boom, there it is. So look at that. This is a daily chart. Look at that candle right there. Solid breakdown. Well below there, no matter what happens, it's not going to make it by the close. We still have negative divergence, and you can see that's it. Divergent high 1. It's not as if it didn't play out. That was a nice trade. We hit that first target. Divergent high 2, another decent correction. What was that? Drop was about 10%. Both of those were roughly 10% drops. And now divergent high 3, but it's just an extension. They're not separate divergences. It's just an extension. The divergence getting bigger and bigger and bigger, and that would be indicative of a much larger drop to come. And so I'll still maintain T3 because if you're going for that, just T3, it would have probably pushed the upper limits of your stops, but still within there. 7% on a 20% downside. That's close to 3-to-1 RR. 31.35, and again on the weekly, that's the same level on the weekly chart. So as of now, that's my final target. Next up is NG natural gas futures. You can of course trade UNG, which is an ETN that tracks natural gas without leverage, or Boyle and Cold, KOLD. Those use two-time leverage. I covered those recently. But here's the futures. This is really the pure play. You can see, natural gas trading almost around the clock, so you're going to see more reaction points. I started focusing on earlier before they rolled, but the March contracts, which we're going to roll to, I think, next week or so. And that was the breakout level 3929, nice resistance. Again, you had this positive divergence building to right here. So there's your officially your divergent low right there as the divergence is built. And then we started to move up, and then before we even broke out, I gave you this uptrend line to watch, in which I said, to both buy pullbacks to after when we get a buy signal, a breakout, the next buy signal, or this buy signal, the breakout there, and also you can use that to set a stop somewhat below. And this is just a beautiful entry today. We pulled back and hit the 3928, that yellow line, the breakout level. So now we've retested the breakout and a perfect tag of that level as well. So that's it. Let's not make it any more complicated. It's where you can go long natural gas, or could have went long today, still could, with a stop somewhat below. The closer you can buy to support, obviously, the tighter you can run a stop. You buy it now, you're going to have to a little give back before it even gets there, and then you got to allow a little bit of room, to allow for a whipsaw if it's going to do that. And that's the March contract. February is still trading. Let me go over that one real quick for those of you in that one. So yesterday we hit, was it, day before, that 488 level right there, pretty big resistance, and that checked the rally. We had that nice rally following the breakout, and this one, the trend looks a little bit above the trend line the way I have it drawn, but not much, so close enough. Plus the March contracts hit it, and you have on this one, there's also some resistance right there. You have a gap and a reaction high. So pretty much for all intents and purposes, this thing's pulled back to resistance too. So I think we could probably make another run up there, quite likely. But, with this natural gas, let it run. Put a stop, let it run. How tight to trail it is up to you. That's always I don't want to call it a double-edged sword, but dilemma. If you go too tight on a volatile security like natural gas, like let's say a 1% or a 0.75% stop loss, trailing stop, the back and forth gyrations will probably clip you out long before the trend is over. The wider stop's going to keep you in the trade and allow you a better chance to catch a bigger trend, but of course you're giving back more profit. So you got to find that fine line, and just meshes with your risk tolerance and really where you think things are going. But either way, just wanted to point out that one, as of now, looks good to next week. If it has another jog down and wants to test that line again or make a full test here on the February contracts, all the better. You can have another shot at it. And again, don't fall in love with it. It really should remain above that 3.953 on the February contracts, and those levels I just showed you on the March. Oh yeah, finally, last but not least, I did get a post out to you. I'll do my best to get static posts out. I know these videos can be hard to catch up on, especially if you're working or have other things going on. But Euro goes all the way back to here. We had a breakout of a beautiful bullish falling wedge pattern, and it worked, played out, ran up, hit my first target there, but then that level became resistance in the top of a trading range. So I've been highlighting it since then and saying we need to break that 114 level. It should swing us up to my targets 114.67, 114.95, and then 115.70, and it did so. We hit the first target. Zoom in to the button. I mean, this is just a great example of technical analysis. I've not played with these lines, modified them. That was a perfect tag followed by a reaction. It was a consolidation pullback in price a little bit and a consolidation time. Then we took it out with a big green candle. We didn't just limp through there. Big green candle, impulsive, shows it was an important level. Hit my next target, the 114, 195 level there, and can have been bouncing between. Remember, resistance once broken becomes support. So this is and we bounced in there, hit that target, and in doing so we also put in that divergent high. It wasn't very big, but enough to cause this pullback here, negative divergence right there on the indicators, and so boom, pulled back and then gave you that entry today at the intersecting support levels, the uptrend line in the 114.09ish level. And you can play E7 directly. You can buy FXE. I always say this: FXE tracks the euro, but it's it's an ETN that's not leveraged. Currencies don't move that much in percentage terms. Now the futures are leveraged, so you just got to get the call right, and you'll make some money. FXE, you're going to have to put some cash into it. Overweight the position size. And if you're interested, let me know. Now, again, my primary reasoning for covering the dollar and the euro is to align it with my analysis on gold. By the way, let me cover the dollar and then we'll get to gold and silver and wrap the video up. And there's the dollar. I mean, it just doesn't get any better than this. This is a level that we needed to break. There was that bearish rising wedge in the dollar, right? We got breakdown there, sell signal, and it worked. And then just like the euro, it consolidated. So this was comparable to the euro breakout. It was a breakdown in the dollar. Boom, when it broke, there's again, a great example of technical analysis. I talk about how when you get these trading ranges, it's like energy, like a coiled spring building. And see, when we broke, we didn't just meander on around for a while. Boom, big impulsive move down right through the trend line, hit that 94.599 level to the button. I mean, again, I didn't put that there. That line was there well in advance. Hit it. Also had a little bit of divergence there as well. See that small little bit of positive divergence there, and that caused that bounce. And now look where we bounced into. And again, all this stuff, it's just, to me, I don't know, stuff amazes me how well the charts can work at times. It has bounced back to that trend line. Let me get this queued up again. Hold on one second. All right, there it is. This is a long-term trend line I've also had on the chart. It goes to the left of the chart here, beyond price. And so look at that. So we went through it on the way down for the reasons I didn't have any resistance on the euro there. And we ran up, and now we're back testing the trend line from below. That's resistance. So bottom line, where the euro pulled back to support today at the lows, the very same time the dollar bounced into resistance. And so rejection here would take us down. You could see a little more upside if it wants to do a full back test of the breakdown level, but I think we'll go down and take the next leg down to 93. And all this ties into gold and silver. Gold and silver, I've given you my thoughts. I update those on a regular basis. I gave you just yesterday, whenever we hit that resistance in the euro, I said, look, probably get a reaction in the euro. There's uptrend lines in gold and silver that could break. I said, probably want to ride it out. I don't expect much of a pullback. And they broke, and we did get a pullback. So, I mean, it's worked perfectly. All this tied in together. The breakdown or the reversal in the euro off resistance coincided with the pullback in silver, which took us below the trend line, which we were on when the euro hit resistance. So, but again, it's not that much for silver, especially. Silver tends to move a lot. It's only down 1% on the futures today, and so that's it. If we hold and we bounce from here in the euro, and reverse in the dollar as well, or we get that little more upside I showed you there, maybe on the dollar. A little more downside would be fine in silver. I'd be a buyer here, add to it. It's an objective add-on about 22.62 right there. And then gold futures, same thing. You had the same trend line. This is a 2-hour candle chart, so it goes back 6 months. And but again, you can see a relatively minor drop since that trend line break, only down 0.3%. So we're still watching this. If the euro can rally next week and the dollar pulls back, whether or not they have a little more, downside in the near term on the euro, I think this will happen. We'll pop that minor downtrend line, run up here, hit that 1840, and that's still a big level. Remember, we did have a breakout. It proved to be a failed breakout because we had a divergent high there, but we still have a lot of reactions. This is a significant technical level in gold. And when the breakout failed, it didn't just meander around either. That shows you that was an important level. The sellers stepped in, but it didn't send gold running way back down. Gold's been consolidating for a while. It doesn't want to go down. It's not going up, but it's not going down. And again, if the currencies play out the way I think they do, and the markets, sooner or later, you're going to see, again, I think there's been an overemphasis on people saying, oh, Bitcoin and cryptos have replaced gold for the flight to safety haven thing. Okay, give it all that. But how many semiconductors do you know? How many electric cars do you know that have circuitry that's made out of Dogecoin and Ethereum? None that I know of. Gold, silver, they're excellent conductors. They have big time industrial applications. So again, you want to, if they get a flight to safety bid during the next correction, great, all the better. But we're in a hyperinflationary environment, and just about everything's been ripping in the last year or so, except gold and silver. So I think they're, on that basis alone, undervalued. And I think the market's going to, recognize that. Again, that's fundamental speak. We'll let the charts be our guide. I'm not going to be married to gold if it does this, and silver if it all of a sudden peters out. But as of now, I don't see anything in the charts, concerning. And again, long-term investors, you're going to be frustrated when you get in a correction mode. I've showed you the long-term charts of gold. It still appears to be a correction in an ongoing bull market, and sooner or later we'll break out of that range, and hopefully it'll be to the upside. And if it's not, it's to the downside. I'll let you know if I feel like shorting it. I don't know. As of now, I'm just more leaning towards the bull side in the metals. All right, let's wrap it up there. And this will probably be the last video of the week unless I see anything that stands out before we close today. This has been Randy Finney with Right Side of the Chart. Have a great weekend.